All right, welcome back, everyone. Ready to dive into another fascinating book?
Absolutely. Always excited to explore these investing classics.
And today we've got a big one, The Intelligent Investor by the one and only Benjamin Graham.
Yeah, it's almost like the investor's Bible, isn't it? So much wisdom packed into those pages.
It really is. So we're going beyond the typical book review here, right? We're digging into those key excerpts, looking at the commentaries, trying to extract those timeless nuggets of wisdom that can still help us navigate the market today.
Exactly. Because the principles Graham lays out, they're not tied to any specific era. They're about understanding the fundamentals of investing, something that's always relevant.
Absolutely. I mean, the guy was not just some academic writing from an ivory tower. Graham was right there on Wall Street, living through the crashes, the booms, the whole roller coaster.
Yeah, that's what makes his work so powerful.
Yeah.
It's grounded in real-world experience. He's not just theorizing, he's sharing hard-won lessons from the trenches.
Exactly. So let's jump right in, starting with Graham's definition of the intelligent investor. Because it might surprise some people, right? It's not about having a sky-high IQ.
Yeah, you don't need to be a genius to be a successful investor, according to Graham.
Right. He was all about temperament, having those key traits, the patience, the discipline, the emotional control.
Yeah, mastering yourself rather than trying to master the market. That's a huge takeaway for me.
I love that. It's about recognizing that our emotions can really trip us up, especially when it comes to investing.
Absolutely. Fear and greed, they can lead to some really bad decisions.
Oh, for sure. Graham put it perfectly when he said, this kind of intelligence is a trait more of the character than of the brain.
So true. And building that character, it takes work. It's about developing those habits, those mental models that help you stay rational even when the market is going crazy.
Exactly.
Hmm.
And one of the first steps, according to Graham, is understanding the difference between investing and speculating.
Oh, yeah, he's very clear about that. They're not the same thing at all.
Right. So, investing, as Graham defines it, is about carefully researching those assets, buying them when they're undervalued, and holding them for the long term.
It's about building wealth steadily over time, almost like constructing a solid building, brick by brick.
I like that analogy. Whereas speculating, that's more like trying to time the market, right? Jumping in and out, trying to ride those waves,
Yeah, and those waves can be pretty unpredictable, can't they? It's much more like gambling, hoping to get lucky and make a quick buck.
which Graham compares to, he compares speculation to playing in a casino, right? Where the odds are, well, not in your favor.
Not at all. And, Wall Street love it when people speculate. They're making money off those commissions, off those trades.
Oh, absolutely. It's not in their best interest to have everyone patiently holding on to their investments for years. They want that action, that churn.
Exactly. And that's why it's so important to understand the game they're playing, to not get caught up in that frenzy.
Now, to help with that, Graham introduces this brilliant analogy of Mr. Market. Can you explain that one to our listeners?
Sure. Imagine you own a piece of a business, right? And every day, this guy, Mr. Market, shows up at your door.
Okay, so far so good.
And he's offering to buy or sell your stake in that business. But the catch is, Mr. Market is incredibly moody.
Oh, I can see where this is going.
One day, he's euphoric, offering you way more than your share is probably worth.
Riding that wave of optimism.
Exactly. But then the next day, he's in despair, practically begging you to sell at a huge loss.
Oh man, that's a roller coaster I know all too well.
Yeah, we've all been there. So the key here, the real brilliance of this analogy, is understanding that you don't have to play Mr. Market's game.
Right, we don't have to let his mood swings dictate our decisions.
Exactly. You don't have to react to his every offer. You can look at your business, assess its true worth, and make rational decisions based on that, not on Mr. Market's emotional state.
It's about tuning out that noise and focusing on the fundamentals.
Exactly. And one of the most important fundamentals, according to Graham, is the margin of safety.
Ah, yes. The margin of safety. I've had that term thrown around, but I'm not always sure what it means in practice. Can you break it down for us?
Sure. So essentially, it's about buying assets for significantly less than their intrinsic value.
Okay, so it's more than just getting a good deal. It's about building in a buffer.
Exactly. It's like having that extra cushion, that safety net, to protect you from unforeseen events or even just errors in judgment.
Because let's be honest, even the best investors make mistakes.
Oh, absolutely. Nobody's perfect. And even the most thorough analysis can't predict the future with 100% accuracy.
Right, so that margin of safety helps you absorb those bumps in the road.
Exactly. It's like hope for the best, but prepare for the worst.
I like that. Now, Graham recognizes that not all investors are created equal, right? He outlines these two main approaches. the defensive investor and the enterprising investor.
Yeah, those are like the two main paths you can take.
So the defensive investor, that's someone who prioritizes safety and simplicity, right? They want to protect their capital and minimize their time commitment.
Exactly. They're not looking to spend hours poring over financial statements. They want a straightforward approach that gives them peace of mind.
Whereas the enterprising investor, they're willing to put in more effort, do more research to potentially achieve higher returns.
They're more active, more hands-on. They enjoy the challenge of digging deep and uncovering those hidden gems.
So it's almost like choosing a hiking trail. Some people prefer a leisurely stroll on a well-marked path, while others enjoy venturing off into the wilderness.
That's a great analogy. And neither approach is better. It really depends on the individual.
Right. It's about understanding your own personality, your risk tolerance, your time constraints, and choosing the path that aligns best with your goals.
Exactly. Now, since our listener is a learner, someone eager to really delve into the details, we'll be focusing more on the enterprising investor's approach in this deep dive.
Perfect. And in the next part, we'll be exploring some specific tactics that Graham recommends for that type of investor, things like dollar cost averaging, focusing on unpopular companies, and really digging into those earnings reports.
It's going to get really interesting. I can't wait to share some of these insights with our listener.
All right, so last time we really dug into Graham's investing philosophy.
Yeah, all about temperament, avoiding speculation, understanding Mr. Market, that margin of safety, all that good stuff.
It's a lot to take in, but it's also relevant even today.
Absolutely. And now we're going to look at how those principles play out in the real world.
Right, we're going to dive into some case histories that Graham uses to illustrate these concepts.
Fascinating stuff, really, because even though he was writing decades ago, the lessons are, well, shockingly timeless.
Yeah, it's amazing how human behavior, how markets work, it doesn't really change all that much.
No, the patterns repeat themselves. So let's start with this company, NVF, National Vulcanized Fiber.
NVF, okay. I gotta be honest, not a name I recognized before diving into the intelligent investor.
Yeah, not exactly a household name these days,
Yeah.
but their story, oh, it's a perfect example of what happens when you get caught up in the hype and ignore the fundamentals.
All right, I'm intrigued. Tell me more. What did they do? What makes their story so noteworthy?
So they were a conglomerate making all sorts of things, fiber, plastics, that kind of stuff.
Okay, sounds pretty diverse.
Yeah, but what's important here is what happened to their stock price during those go-go years of the 1960s.
Ah, the go-go years. A time of unbridled optimism, shall we say.
Yeah, irrational exuberance, as they say.
Well,
And NVF's stock, ooh, it went on a wild ride.
give me the numbers.
From around $6 a share in 61, it shot up to over $200 by 68.
Whoa. Okay, so what fueled that kind of growth? Was it, actual performance or something else?
That's the million-dollar question.
Right.
And the answer is, it was mostly speculation, pure hype.
So investors were just throwing money at anything that smelled like growth, whether it was justified or not.
That's exactly it.
Hmm.
They were buying the story, not the underlying business. And the company's earnings, well, they couldn't keep up with that stock price.
Classic case of a bubble, then.
Textbook example. And what goes up? Well, we all know what happens next.
Yeah, gravity takes over eventually.
Right, so by 1970, NVF's stock had crashed back down to $20 a share.
Ouch. Talk about a roller coaster. Must have been painful for anyone who bought in at the peak.
Devastating for a lot of folks. And that's the lesson here, right? The danger of speculation. When a stock price gets detached from the underlying value of the business, it's only a matter of time before reality sets in.
It's like building a house of cards.
Exactly. So let's move on to another case, shall we? This one's a bit more recent, but just as fascinating. The merger of AOL and Time Warner back in 2000.
Oh, yeah, I remember that one. Peak.com bubble, wasn't it?
Prime example. Remember, back then, anything internet-related, it was like gold.
Valuations were through the roof. People were throwing money at anything with a .com in its name.
Absolutely. So you had Time Warner, this massive media giant, cable, magazines, movies, the whole shebang.
Yeah, old guard, right. All right.
And then you had AOL, hugely popular, but basically an internet service provider.
David and Goliath, except, well, David ate Goliath in this case.
Yeah, the merger was valued at a whopping $164 billion.
A record at the time, right?
It was. And think about it, AOL, they had a fraction of the assets and revenue of Time Warner, but they were calling the shots.
That's crazy. So what were people thinking? Was it just pure .com mania?
I think a lot of it was just that frenzy, that belief that anything internet-related was going to skyrocket in value. AOL's stock It was trading at like 164 times its earnings.
While Time Warner was at a more, shall we say, reasonable 50 times earning.
Right. It's like the internet just magically inflated valuations, regardless of actual profitability.
So what happened? Did this merger of equals live up to the hype?
Not even close. It was a disaster, a colossal failure.
Wow. So what went wrong? Clash of cultures, bad execution?
It was a lot of things. Integrating two such different companies was a nightmare. AOL's growth tanked as the dot-com bubble burst. The stock price plummeted. It's considered one of the worst mergers in history, really.
A cautionary tale for sure.
Yeah.
Shows how hype can lead to some really bad decisions, even at the highest levels.
Absolutely. These case histories, they're not just stories, they're lessons.
Right. They show how these patterns of behavior, of market psychology, they repeat themselves over and over.
Exactly. And they highlight the importance of staying grounded,
Yeah.
focusing on those fundamentals.
Right. Not getting swept up in the excitement, the mania of the moment. Which brings us to another key concept from Graham's book, the idea of super investors.
All right, welcome back to our deep dive into the intelligent investor. We've covered a lot of ground already, but we're not done yet.
Not even close. We've still got some crucial stuff to unpack, things that can really help you put Graham's principles into action.
Okay, so let's talk about one of the biggest challenges for any investor, especially those just starting out, dealing with those market
Oh,
fluctuations.
yeah, those ups and downs, they can be nerve-wracking.
Absolutely. So how do we navigate that? How do we stay calm when the market takes a dive?
Well, Graham, he offers some really solid advice on this. He emphasizes the importance of, well, focusing on the long game.
Right, not getting caught up in the short-term noise. Exactly. He actually says, for the true investor, price fluctuations have only one significant meaning.
Oh, I like this.
They provide an opportunity to buy wisely when prices fall sharply, and to sell wisely when they advance a great deal. At other times, he says, you're better off forgetting about the stock market entirely and paying attention to the operating results of your companies.
So basically, tune out the noise and focus on the fundamentals.
That's it. Easier said than done, though, right?
Yeah, I mean, it's easy to get caught up in that emotional roller coaster, that urge to panic sell when things get shaky.
I get it. We've all been there. But that's where this concept of the investment owner's contract comes in.
Okay, I've never heard of that. What is it?
It's a mental exercise, really. Imagine signing a contract stating that you won't sell your stocks for at least 10 years, no matter what.
10 years. Whoa, that's commitment.
Right. It forces you to think differently.
Yeah.
No more knee-jerk reactions.
You'd have to really believe in those businesses you're buying.
Exactly. You're shifting your focus from short-term price movements to the long-term health of those companies. You're thinking like a true owner.
I like that. So let's talk portfolio construction. Graham, he has some pretty specific guidance on how an intelligent investor should allocate their assets, right?
Yeah, he recommends a balance, stocks and bonds.
Okay, the classic mix.
Right, but the exact ratio, well, that depends.
On your risk tolerance, your time horizon, all that.
Exactly. For the defensive investor, he suggests a minimum of 25% in stocks, max of 75%.
So even the most conservative investor should have some exposure to the growth potential of stocks.
Definitely. And for the more enterprising types, he goes up to 50% to 75% in stocks.
It's like creating your own recipe, adjusting those ingredients based on your taste and what you're trying to achieve.
I like that analogy. Now, for those who maybe want a more hands-off approach, there's always investment funds.
Right, mutual funds, index funds, that kind of thing.
Exactly. And Graham, he acknowledges that they can be a good option for a lot of folks.
Especially those who don't have the time or the expertise to pick individual stocks.
Right. But he does have some warnings, watch out for high fees, excessive trading, that kind of thing.
Oh, yeah. Those fees can really eat into your returns over time.
For sure. And be wary of chasing performance. Past results don't guarantee future success.
Right. That's the classic disclaimer, but it's so true. Don't just jump into the hottest fund. Do your research.
Absolutely. Understand the fund strategy. Look at those expenses. Think for yourself.
It's all about being an informed investor, taking control of your financial destiny.
That's what Graham is all about.
Yeah.
Now, one more crucial thing we got to touch on. Understanding financial statements.
Ah, yes, the language of business.
Right. But don't be intimidated. Think of them like a roadmap to a company's financial health.
Okay, that helps.
You can see their profitability, their assets, their debts, how the cash is flowing. It's like peeking under the hood to see how the engine's running.
So, by learning to read these statements, you gain a deeper understanding of those businesses you're investing in.
Exactly. You can spot red flags, identify potential opportunities, make smarter decisions.
It's like having a secret decoder ring. You can see things that others might miss.
Absolutely. Now, as we wrap up our deep dive into the intelligent investor, I want to bring it back to that overarching theme, temperament.
Right, because it's not just about the numbers, it's about having the right mindset.
It's about understanding that the biggest obstacle to success, well, it's often ourselves.
Our emotions, our biases, those knee-jerk reactions.
Exactly. Fear and greed, they can really cloud our judgment.
Oh, yeah, we can make some really bad decisions when we're driven by those emotions.
And that's why Graham, he put so much emphasis on patience, discipline, emotional detachment. It's about staying grounded, sticking to your principles, not letting the market swings dictate your actions.
Right, staying calm amidst the storm, remembering those long-term goals.
Absolutely.
Huh.
Now, I want to leave our listeners with this question. If you had to pick one principle from The Intelligent Investor to guide your investing decisions for the rest of your life, which would it be and why?
Wow, that's a tough one. It really makes you think. So many great insights in this book.
It does. It's about finding that one principle that resonates most deeply with you, that you believe will be the most valuable guide on your journey.
Yeah, like choosing the one tool you'd take with you on a deserted island.
Exactly. For me, I think it would have to be the margin of safety. That idea of buying assets for less than they're worth, creating that cushion to protect yourself, it just feels so fundamental, so powerful.
I can see why you'd choose that. It really aligns with everything Graham teaches about avoiding losses, staying rational, thinking long term.
Absolutely. Now, we've only scratched the surface of the intelligent investor, but hopefully this deep dive has given you a good foundation, a starting point for your own exploration.
I think so. It's definitely inspired me to go back and reread the book, highlight those key passages, really internalize those lessons.
That's great to hear. And remember, investing doesn't have to be complicated or stressful. It's about using your intelligence, both intellectual and emotional, to make sound decisions and build a secure financial future for yourself.
So, to our listeners, if you're looking for a timeless guide to navigating the market, The Intelligent Investor by Benjamin Graham is an absolute must read.
Go forth and invest intelligently.